a young man named Sam, a trader with big dreams, but plagued by constant losses in the market. No matter how much research he did, the market seemed to have a mind of its own, always catching him off guard. Sam felt defeated, ready to give up, until he stumbled upon a book that would change his perspective entirely. Reminiscences of a Stock Operator by EDWIN LEFÈVRE. As he read, Sam found himself drawn into the story of Larry Livingston, a character based on the legendary trader Jesse Livermore. Larry's journey mirrored Sam's own frustrations, but with one key difference: Larry's resilience and unwavering commitment to learning from his mistakes. This book became Sam's guide, helping him to transform his approach to trading and, ultimately, to find success. Chapter 1. Early Days and Learning the Market. The story of Larry Livingston begins in a small brokerage office, where, as a young bored boy, he updates the stock prices on a chalkboard. Larry is no ordinary boy. He has a rare ability to see patterns in the numbers he's handling, quickly realizing that certain stocks move in ways that reveal trends and behaviors. Fascinated by this world of finance, Larry learns one of his earliest lessons. The stock market isn't purely logical or predictable. It's driven by human behavior. Larry starts out trading small amounts in bucket shops, unofficial brokers where traders bet on stock price movements without actually owning the shares. These shops allowed young Larry to place small bets with the money he had saved up, allowing him to test his instincts and grow his confidence in his understanding of market trends. The power of observation, developing an instinct. While working in the bucket shop, Larry sees patterns emerging in stock price movements. His early wins are based on this intuitive understanding of patterns, something he describes as a feel for the market. But he quickly discovers that success in trading is about more than intuition. It requires disciplined observation and study of market behavior. Larry's knack for spotting trends lays the foundation for his future success. He understands that stock prices don't just change randomly. Instead, they often reflect the emotions and psychology of the people investing in them. This insight becomes a cornerstone of Larry's trading strategy. Key takeaways from Larry's early experience. Market patterns. Larry learns that stock prices are often influenced by human emotions and behaviors, not just by company performance. The psychology of traders. Larry's experiences teach him that human factors, like greed and fear, often drive the market in unexpected ways. Importance of observation. He realizes that keen observation, paying attention to patterns and trends, can give him an edge in trading. Learning from losses and wins. Testing limits in bucket shops. Larry's early trades lead to small wins and occasional losses. He begins to see that when he ignores his instincts or rushes into a trade, it often leads to losses. He understands that each win or loss is a learning opportunity, shaping his strategy and helping him develop discipline. His time in the bucket shops teaches him to test his theories on a small scale before making larger trades, providing him with practical, low-risk experience. He also learns how quickly the market can change and how important it is to remain flexible in the face of uncertainty. Important lessons Larry learns in bucket shops. Instinct versus overconfidence. Early successes in trading can lead to overconfidence, but Larry learns to listen to his instincts rather than assuming he knows it all. Testing theories on a small scale. By betting small amounts, Larry can explore different strategies without risking all his capital. Flexibility and adaptability. The market is unpredictable, and Larry's early experiences teach him the importance of adjusting his strategy based on new information. Understanding the market as a reflection of human psychology. One of the most powerful lessons Larry learns is that the stock market is a mirror of human psychology. People's emotions, like fear, greed, and hope, are often the forces behind price changes. Larry sees that when people are overly optimistic, prices may go up unrealistically. When they're fearful, they might drive prices lower than they deserve to be. This insight helps Larry begin to think of trading as a study of psychology as much as finance. He understands that the greatest traders are those who can read and anticipate the emotional reactions of the masses, not just the financial data. Key psychological insights from Larry's experience. The role of fear and greed. Larry sees firsthand how these emotions often drive people to make irrational trading decisions. Reading the markets. Mood. Successful trading involves assessing the overall market sentiment and acting accordingly. Anticipating reactions. Larry begins to see that, by understanding what drives other traders' decisions, he can predict stock movements more accurately. Developing discipline. The path to consistent success. Larry's early trading experiences teach him that discipline is just as important as intuition. He learns to wait for the right moment, observing carefully before making a move. Over time, he develops a set of guiding principles that keep him from making rash decisions. He realizes that consistent success isn't about quick profits. It's about patience and the discipline to follow a strategy. Discipline lessons from Larry's early days. Patience over impulse. Larry learns to resist the urge to act on every hunch, waiting instead for a clear trend to emerge. Creating rules. He begins to set personal rules for trading, helping him avoid impulsive decisions. Avoiding overtrading. By being selective and patient, Larry ensures that he only enters trades when he's confident in his analysis. Through his early days in the brokerage office and bucket shops, Larry Livingston develops the core skills that will guide him through his career. He understands the market as a reflection of human emotions, learns to trust his instincts while remaining humble, and begins cultivating the discipline to follow a strategy. His early wins and losses serve as lessons, teaching him that success in trading requires more than just luck. It demands a blend of patience, insight, and self-control. This foundational knowledge sets Larry on a path to become a successful stock operator, ready to navigate the challenges and uncertainties of Wall Street. Chapter 2. Going Broke and the Role of Discipline. In Larry Livingston's trading journey, his initial success in the bucket shops gives him confidence, maybe a little too much confidence. As he starts to win consistently, he feels like he's on top of the world, convinced that he's found the secret to the stock market. This sense of invincibility pushes him to make bigger bets, often without the same level of careful analysis or patience that had brought him success in the beginning. And that's when he faces one of his greatest challenges, going broke. The book emphasizes that one of the most dangerous traits for any trader is overconfidence. Livingston learns this lesson the hard way when a series of bad trades wipes out his savings, forcing him to reevaluate his approach. This experience humbles him and leads him to realize that success in the market is about more than skill. It requires discipline, humility, and a willingness to learn from mistakes. Early signs of overconfidence. In the early days of his trading career, Livingston's success feeds his ego. He starts to think that he's different from other traders, that he has a unique gift for predicting the market's movements. This mindset makes him reckless, leading him to place bets without the same caution he initially had. His rapid wins make him believe that he can skip some of the analysis and go straight to the profits, but this thinking soon becomes his undoing. Key lessons from overconfidence. Believing in invincibility. Overconfidence can make a trader believe they're untouchable, ignoring the reality that every trade carries risk. Skipping analysis. When a trader believes they can win no matter what, they may neglect essential analysis, leading to careless decisions. Ignoring risk management. With too much confidence, Livingston takes on larger positions without considering the potential downside. The wake-up call, going broke. One of the most pivotal moments in Livingston's career comes when he loses everything. A series of impulsive trades wipe out his account, and he's left with nothing but the painful realization that he's not as invincible as he thought. This experience is a turning point, a wake-up call that forces him to confront his own shortcomings. Livingston's losses serve as a reminder that the market doesn't reward recklessness. Every loss he suffers is a lesson in humility, teaching him that successful trading is about consistency and long-term thinking, not quick wins. He begins to understand that every trade should be approached with respect for the market and a solid plan. Key takeaways from going broke. The market humbles everyone. No matter how talented or experienced a trader may be, the market can humble anyone who doesn't respect its power. Learning from losses. Each loss is a chance to learn and improve, rather than a reason to give up. Building resilience. Going broke teaches Livingston to handle setbacks and to keep moving forward with greater discipline. The importance of discipline. Discipline becomes the cornerstone of Livingston's approach after going broke. He realizes that without discipline, he's at the mercy of his emotions, which can lead to impulsive decisions and catastrophic losses. Discipline helps him create a set of rules to guide his trades, keeping his emotions in check and allowing him to make decisions based on analysis, rather than feelings. Livingston's newfound discipline includes setting boundaries on his trades, knowing when to walk away, and waiting for the right opportunities. He learns that discipline is about following a plan and resisting the temptation to deviate from it when emotions run high. Discipline lessons for successful trading. Setting rules. Creating personal guidelines helps traders make decisions with clarity and consistency. Avoiding impulsive trades. Discipline helps prevent the urge to jump into trades based on emotion or gut feelings. Sticking to a plan. A well-thought-out trading plan ensures that trades are made with logic, not reactionary impulses. Learning patience. Livingston's journey teaches him that discipline is closely tied to patience. He learns that success in the market often requires waiting for the right moment to strike, rather than forcing trades in unfavorable conditions. Patience becomes a powerful tool, allowing him to step back, assess the market, and wait for high-probability setups rather than chasing every opportunity. Through patience, Livingston understands that not every moment is ideal for trading. Some of his biggest losses came from impatience, from trying to make a profit even when the market was unclear or unfavorable. He learns that sometimes the best trade is no trade at all. Benefits of patience. Waiting for clear opportunities. Instead of forcing trades, patient traders wait for setups that align with their strategy. Avoiding unnecessary risk. Patience helps traders avoid entering trades in uncertain or volatile conditions. Long-term success. Consistently waiting for ideal conditions leads to better outcomes over time. Humility and growth. Adapting to market realities. After going broke, Livingston realizes that the market doesn't care about his past successes. The only way to thrive is to remain humble, constantly learning and adapting. He embraces his losses as learning experiences and understands that to succeed, he must continuously grow and refine his strategies. Humility allows him to look at his mistakes objectively rather than viewing them as personal failures. By staying humble, Livingston opens himself to new knowledge and growth. He no longer sees himself as an expert, but as a student of the market, always seeking to improve. Growth and humility principles. Embracing mistakes. Viewing losses as lessons helps traders grow and improve. Avoiding arrogance. Humility keeps traders grounded and open to new insights. Continuous learning. A humble approach fosters a mindset of lifelong learning and improvement. In Chapter 2, Larry Livingston's journey underscores the importance of discipline, patience, and humility in trading. His experience going broke transforms his approach, teaching him to respect the market, follow a plan, and control his emotions. These lessons lay the foundation for his future success, proving that the most valuable asset for any trader isn't necessarily skill or knowledge, but the discipline to manage oneself. Larry's experience reminds us that in the stock market, discipline is non-negotiable. Only by learning to control his emotions and follow a plan does he truly begin to understand the art of trading. Going broke serves as a profound lesson, showing him that the path to long-term success isn't a sprint but a marathon, where patience, humility, and discipline are the ultimate tools for survival. Chapter 3. Strategies and the Science of Speculation. As Sam dove deeper into the book, he learned that trading was a science. Larry discovered that the market moved in predictable patterns, not by luck or random events. This idea became Sam's trading philosophy. He adopted a systematic approach, studying trends, analyzing data, and waiting for confirmation before making a move. Sam stopped chasing rumors and started trusting his own research. This shift helped him develop a sense of control over his decisions. Instead of basing his trades on gut feelings, he waited for the right signals, gradually building a reliable strategy. Chapter 4. Managing Emotions, the Psychology of a Trader. One of the most impactful lessons Sam learned from Larry was about the importance of managing emotions. Like Larry, Sam realized that emotions, specifically fear and greed, were his biggest obstacles. Fear led him to hold on to losing trades, while greed urged him to stay in profitable trades too long. Larry's experiences taught Sam to keep a clear mind and avoid reacting emotionally to market fluctuations. He worked on detaching himself from trades, treating each one as a calculated decision rather than an emotional investment. This detachment allowed him to act strategically, minimizing losses and maximizing gains. Chapter 5. Avoiding Tips and Market Gossip. In the fast-paced world of stock trading, the temptation to follow the crowd can be overwhelming. For Larry Livingston, the journey through the stock market is riddled with the allure of tips, rumors, and market gossip. This chapter highlights his evolution from a trader, influenced by external noise, to one who relies on his own analysis and instincts, emphasizing the importance of independent thinking. The allure of market gossip. When Livingston first enters the world of trading, he's captivated by the buzz surrounding him. The stock market floor is alive with chatter. Tips fly around like confetti, and traders eagerly share what they've heard. This atmosphere creates a false sense of certainty, where gossip and rumors can feel just as valid as thorough research. Livingston quickly learns that this environment can lead to dangerous decisions. While it's easy to get caught up in the excitement of the latest tip, he realizes that relying on external information can lead to poor trading outcomes. More often than not, these tips are based on speculation rather than facts, leaving traders vulnerable to losses. Key insights about market gossip. Noise versus information. Traders must differentiate between genuine market information and mere speculation. Groupthink. Following the crowd can lead to collective mistakes, especially if the prevailing sentiment is misguided. Short-lived tips. Tips are often based on temporary movements and can lead to rash decisions that ignore the bigger picture. The cost of following tips. One of Livingston's most significant lessons comes when he acts on a popular tip from a fellow trader. Encouraged by the buzz, he makes a hasty investment without conducting his due diligence. The stock initially rises, fueling his excitement, but soon crashes as reality sets in. This experience teaches him the harsh truth. Tips can be misleading and often lead to financial ruin. Through this experience, Livingston learns to view tips with skepticism. He understands that even seemingly credible information can turn out to be unreliable. This realization is crucial. He begins to appreciate that successful trading requires thorough analysis and a strong understanding of the market rather than blind faith in others' opinions. Consequences of following tips. Impulsive decisions. Acting on tips can lead to snap judgments without proper analysis. Loss of control. Relying on others' compromises. A trader's ability to take responsibility for their trades. Emotional turmoil. Following tips can lead to anxiety and stress when market movements don't align with expectations. Building independent analysis. As Livingston reflects on his past mistakes, he recognizes the importance of developing his analytical skills. He starts to focus on understanding the fundamentals of the stocks he trades and the broader market context. This shift marks the beginning of his transformation into a more disciplined trader. Livingston embraces the notion that he must rely on his insights and research. He dedicates time to studying charts, reading financial reports, and staying informed about market trends. By grounding his decisions in his analysis rather than external noise, he gains confidence and clarity in his trading. Steps to build independent analysis. Conducting research. Dedicating time to research helps traders form their insights rather than relying on tips. Studying charts. Analyzing price movements and patterns gives traders a better understanding of market trends. Understanding fundamentals. Knowing a company's financial health and industry position helps traders make informed decisions. The value of personal experience. Through his journey, Livingston learns that personal experience is an invaluable asset in trading. Every trade, whether successful or not, provides insights that shape his understanding of the market. He begins to trust his instincts, knowing that he can learn from his mistakes and successes alike. Livingston's experiences teach him to question the validity of external advice. Instead of accepting tips at face value, he considers how they fit into his overall trading strategy. This shift fosters a sense of ownership over his trades and decisions, reinforcing the notion that a successful trader must be proactive rather than reactive. Benefits of personal experience. Learning from mistakes. Analyzing past trades, both successful and unsuccessful, helps improve future decision-making. Developing intuition. Personal experience builds confidence in one's instincts and judgment. Owning decisions. Taking responsibility for trades fosters accountability and encourages independent thinking. Embracing critical thinking. Livingston's journey highlights the importance of critical thinking in trading. Instead of blindly following market gossip or tips, he learns to analyze the motives behind them. Who benefits from this information? What are the underlying facts? By approaching trading with a critical mindset, he can sift through the noise and make more informed decisions. This critical thinking approach also allows Livingston to identify patterns in the market. He learns to look beyond short-term movements and rumors, focusing instead on long-term trends and reliable data. This shift in perspective ultimately contributes to his success as a trader. Principles of critical thinking. Questioning sources. Always evaluate the credibility of information before acting on it. Analyzing motivations. Consider who benefits from the information being shared and why. Looking for patterns. Focus on long-term trends rather than short-term fluctuations to make informed decisions. Conclusion of Chapter 5. Independent Trading Mindset. In Chapter 5 of Reminiscences of a Stock Operator, Larry Livingston's evolution from a trader, influenced by tips and market gossip, to one who relies on his analysis highlights the importance of independent thinking in trading. He learns that the stock market is not about following the crowd, but about making informed decisions based on careful research and personal experience. This chapter serves as a powerful reminder to traders that the path to success lies in developing their own insights rather than succumbing to the noise of the market. By avoiding tips and focusing on critical thinking, traders can build a more resilient and effective trading strategy. Livingston's journey reinforces the idea that the true key to trading success is not merely in knowing what others say, but in understanding the market on one's own terms. Chapter 6. Importance of Risk Management. As Larry Livingston navigates the tumultuous waters of the stock market, one crucial lesson becomes abundantly clear. Effective risk management is the cornerstone of successful trading. In this chapter, Livingston learns that understanding and mitigating risk is not merely an afterthought. It's an essential strategy for survival and growth in the trading world. The nature of risk in trading. In the early stages of his trading career, Livingston experiences the thrill of profit but quickly faces the sobering reality of loss. The stock market is inherently risky, and every trade carries the potential for both gains and losses. For every successful trade, there is a counterbalance of risk that must be acknowledged. Livingston learns that risk comes in various forms. Market risk, the potential for losses due to market fluctuations. Prices can change rapidly based on news, trends, or broader economic factors. Liquidity risk, the risk of being unable to sell a security without incurring significant losses due to lack of market activity. Credit risk, the chance that a counterparty will fail to fulfill their contractual obligations, particularly in derivatives or options trading. By recognizing these risks, Livingston begins to understand that risk management is not about avoiding losses altogether, but about minimizing them and maximizing potential gains. Developing a risk management strategy. One of Livingston's pivotal moments comes when he realizes that having a risk management strategy is as vital as knowing how to make profitable trades. He adopts a disciplined approach to assess the risks associated with each trade before making any commitments. This strategy involves setting clear parameters to protect his capital. Risk management strategy, position sizing, determining how much of his capital to allocate to a single trade. By limiting exposure, he safeguards his account against catastrophic losses. Stop-loss orders, establishing automatic sell orders to exit a trade at a predetermined price. This mechanism helps prevent emotional decision-making during market volatility. Diversification, spreading investments across different assets or sectors to reduce the impact of a poor-performing investment on his overall portfolio. Through these strategies, Livingston learns to approach trading with a calculated mindset rather than relying on gut feelings or impulsive decisions. The role of stop-loss orders, one of the most effective tools Livingston discovers in managing risk, is the use of stop-loss orders. These orders act as a safety net, automatically selling a security when it reaches a certain price. By setting stop-loss orders, Livingston protects himself from devastating losses that could occur during unexpected market downturns. Benefits of stop-loss orders. Emotional control. Stop-loss orders eliminate the emotional turmoil associated with deciding when to exit a losing position. Traders are less likely to hold on to a losing trade out of fear or hope. Predefined exit points. They provide clarity and discipline, ensuring that decisions are made based on strategy rather than emotions. Capital preservation. By preventing excessive losses, stop-loss orders help maintain capital for future trading opportunities. Livingston's use of stop-loss orders exemplifies the importance of safeguarding his investments while allowing for the potential of profits. Learning from past mistakes. Livingston's journey is not without its share of mistakes. He recounts times when he ignored his own risk management principles and faced severe consequences. Each of these experiences becomes a learning opportunity, reinforcing the need to adhere to his risk management strategy. Through his failures, he discovers that losses are part of the trading experience. However, the key to long-term success lies in learning from those mistakes and adjusting his approach. By keeping a journal to document trades and their outcomes, he gains insights into his behavior and decision-making processes. Lessons learned from mistakes. Acceptance of losses. Acknowledging that losses are an inevitable part of trading helps him maintain perspective and resilience. Continuous improvement. Analyzing past trades and mistakes fosters a mindset of growth, encouraging him to adapt and refine his strategies. Emphasizing discipline. Each setback reinforces the importance of sticking to his risk management principles, reminding him that discipline is the bedrock of successful trading. Risk management as a mindset. Livingston comes to realize that risk management extends beyond mere strategies. It is a mindset that permeates every aspect of trading. He adopts a proactive approach, always assessing the potential risks before making any trade decisions. This mindset empowers him to make informed choices rather than being driven by fear or greed. Characteristics of a risk-aware trader. Analytical thinking. A risk-aware trader analyzes potential outcomes and weighs the risks versus rewards of each trade. Emotional intelligence. Understanding one's emotional triggers helps prevent rash decisions that could lead to losses. Long-term perspective. Focusing on overall performance rather than short-term gains encourages traders to prioritize risk management consistently. By embracing this mindset, Livingston solidifies his reputation as a disciplined trader who approaches the market with caution and foresight. Conclusion of Chapter 6. Mastery through Risk Management. In Chapter 6 of Reminiscences of a Stock Operator, Larry Livingston's evolution in understanding the importance of risk management shapes his trading philosophy. Through disciplined strategies, such as position sizing and the use of stop-loss orders, he learns to navigate the inherent risks of trading while protecting his capital. This chapter serves as a powerful reminder that successful trading is not about eliminating risk. It's about managing it effectively. By adopting a proactive mindset and learning from past mistakes, traders can cultivate resilience and adaptability in a volatile market. Livingston's journey reinforces the idea that mastery in trading comes not just from understanding the market, but from mastering oneself and the principles of risk management. Chapter 7. Recognizing Market Cycles. In Chapter 7 of Reminiscences of a Stock Operator, Larry Livingston deepens his understanding of the stock market by recognizing and navigating the inherent market cycles. This pivotal realization transforms his approach to trading and helps him achieve consistent success amidst the volatility of the market. Understanding market cycles. Every trader knows that markets do not move in a straight line. Instead, they ebb and flow in cycles influenced by various factors, including economic indicators, investor sentiment, and broader societal trends. Larry learns to identify these cycles and adjust his trading strategies accordingly, understanding that they are a natural part of the market landscape. Key characteristics of market cycles. Bull markets. A bull market is characterized by rising prices and overall investor confidence. During this phase, traders are optimistic and buying activity tends to increase. Prices climb steadily, and many stocks experience significant upward momentum. Bear markets. Conversely, a bear market is marked by declining prices and a pervasive sense of pessimism. Investors are fearful, leading to selling pressure and an overall downward trend in stock prices. During this phase, it becomes crucial for traders to adopt a more cautious approach. Consolidation phases. Between bull and bear markets, there are often consolidation phases where the market moves sideways, prices stabilize, and traders may experience a period of indecision. Recognizing these phases can help traders avoid making impulsive decisions based on short-term fluctuations. The importance of timing. As Livingston reflects on his experiences, he realizes that timing is everything in trading. Understanding where the market is within its cycle enables him to make informed decisions about when to enter or exit trades. This knowledge empowers him to position himself for maximum profitability. Timing strategies. Entering during bull markets. Larry learns that entering trades during bull markets can significantly increase his chances of success. In this phase, he looks for strong upward trends and builds his positions accordingly, often employing momentum strategies to capitalize on the prevailing sentiment. Exiting during bear markets. Conversely, during bear markets, he becomes more cautious. Recognizing signs of a downturn allows him to exit positions early and protect his capital. He implements stop-loss orders more aggressively during these periods to prevent excessive losses. Sitting on the sidelines. One of the most profound lessons for Larry is the importance of knowing when to stay out of the market entirely. During consolidation phases or when market signals are unclear, he learns to exercise patience and refrain from trading, understanding that not every moment is opportune for entering the market. Observing economic indicators. Larry's keen observation skills enable him to track economic indicators that often signal changes in market cycles. He learns that economic data, such as unemployment rates, GDP growth, and consumer sentiment, can provide valuable insights into the health of the economy and its potential impact on the stock market. Key economic indicators. Interest rates. Changes in interest rates can significantly influence market cycles. For instance, when the Federal Reserve lowers rates, it often stimulates economic growth and can lead to a bull market. Conversely, rising rates may signal a cooling economy and contribute to a bear market. Inflation rates. High inflation can erode purchasing power and lead to decreased consumer spending, often resulting in a bear market. Conversely, moderate inflation during economic growth can support a bull market. Corporate earnings. The performance of companies in terms of earnings reports can also signal the direction of market cycles. Strong earnings often lead to increased investor confidence and a bull market, while disappointing earnings can trigger sell-offs and a bear market. By integrating economic indicators into his analysis, Larry becomes a more informed trader, able to anticipate shifts in market sentiment and adjust his strategies accordingly. The psychological aspects of market cycles. Understanding market cycles is not just a mechanical process. It's also deeply rooted in human psychology. Livingston realizes that the emotions of fear and greed significantly influence market movements. These emotions drive investors to react impulsively, often leading to exaggerated market swings. Psychological patterns. Euphoria in bull markets. During bull markets, the sense of euphoria can lead traders to become overly optimistic. This mindset can result in reckless trading behavior, as investors chase after rising prices without proper analysis. Panic in bear markets. Conversely, in bear markets, fear can overwhelm traders. The fear of losing capital may cause panic selling, leading to further declines. Recognizing these psychological patterns helps Livingston maintain a level head during volatile times. By acknowledging the psychological components of market cycles, Larry is better equipped to manage his emotions and make rational decisions, steering clear of the herd mentality that often plagues traders. Adapting trading strategies to market cycles. As Livingston becomes adept at recognizing market cycles, he develops a repertoire of trading strategies tailored to different phases of the market. This adaptability proves crucial to his success. Tailored strategies. Trend following. In bull markets, he focuses on trend-following strategies, identifying stocks that are experiencing upward momentum. He employs technical analysis to spot entry points and ride the wave of positive sentiment. Short selling in bear markets. During bear markets, Larry capitalizes on downward trends by short selling. By identifying stocks that are likely to decline, he can profit from falling prices while protecting his capital. Swing trading during consolidation. In consolidation phases, he turns to swing trading, seeking to capitalize on short-term price movements. By identifying key support and resistance levels, he can execute trades within a defined range. Continuous learning and adaptation. Larry's journey through the recognition of market cycles underscores the importance of continuous learning. He realizes that the market is dynamic and conditions can change rapidly. Staying informed about global events, economic changes, and market sentiment becomes essential to his success. Commitment to growth. Market analysis. Larry dedicates time each day to analyze market trends, studying charts, and reading financial news. This commitment keeps him informed and ready to adjust his strategies as necessary. Feedback loop. He learns to maintain a feedback loop by evaluating the outcomes of his trades and reflecting on whether he followed his principles regarding market cycles. This practice fosters growth and helps him refine his approach. Networking with other traders. Connecting with other traders allows Larry to share insights and learn from their experiences. This exchange of knowledge enhances his understanding of market cycles and keeps him grounded in reality. Chapter 7 of Reminiscences of a Stock Operator serves as a critical turning point in Larry Livingston's trading journey. By recognizing market cycles, he transforms his approach to trading, integrating economic indicators and psychological insights into his strategy. Through disciplined observation, adaptability, and a commitment to continuous learning, Larry learns to navigate the complexities of the stock market with greater confidence. This chapter illustrates that success in trading is not merely about predicting price movements, but also about understanding the broader context in which those movements occur. Recognizing market cycles empowers traders to make informed decisions, manage risk effectively, and ultimately achieve sustained success. As Larry moves forward, he carries with him the invaluable lesson that the ability to recognize and adapt to market cycles is a hallmark of a successful trader. This insight not only enhances his trading skills, but also reinforces his resilience in the face of an ever-changing market landscape. Chapter 8. The Power of Observation. In Chapter 8 of Reminiscences of a Stock Operator, Larry Livingston emphasizes one of the most crucial yet often overlooked skills in trading, the power of observation. As he navigates the complex and often chaotic world of the stock market, Livingston learns that careful observation can provide invaluable insights that can significantly impact trading success. The art of noticing. For Larry, observation is not merely about watching stock prices. It's about understanding the myriad factors that influence market behavior. He discovers that the best traders are those who develop a keen sense of awareness about their surroundings, the people they trade with, and the broader economic context. Key aspects of effective observation. Market sentiment. One of the first things Larry learns to observe is market sentiment. By paying attention to how traders and investors react to news, earnings reports, and economic indicators, he can gauge the overall mood of the market. This insight allows him to make more informed trading decisions, aligning his strategy with prevailing sentiment. Behavior of other traders. Larry becomes acutely aware of the behaviors and reactions of other traders in the market. He watches how they respond to price movements, news, and rumors. Understanding these behaviors gives him a competitive edge, as he can anticipate how the crowd will react and position himself accordingly. Volume and price movements. Observing trading volume alongside price movements is another critical component of Larry's observational strategy. He learns that significant price changes, accompanied by high volume, often signal stronger trends than those with low volume. This understanding helps him differentiate between genuine market moves and fleeting spikes. The importance of context. Livingston realizes that observations must be made in context. For instance, a sudden drop in stock prices might seem alarming, but if it occurs during a broader market correction, it may not be as concerning. Contextualizing observations allows Larry to filter out noise and focus on what truly matters. Contextual observations include broader economic conditions. Understanding the economic environment is vital. Larry observes macroeconomic indicators like inflation rates, unemployment statistics, and GDP growth to better gauge how they might affect market trends. Company fundamentals. Observing a company's fundamentals, such as earnings reports, management decisions, and industry trends, provides a clearer picture of whether a stock's price movement is justified or simply driven by speculation. Global events. In an interconnected world, Larry understands that global events can impact local markets. He learns to observe geopolitical developments, trade agreements, and international economic trends that may influence stock prices. Developing analytical skills. To harness the power of observation effectively, Livingston works on sharpening his analytical skills. He learns that observation alone is not enough. It must be combined with critical thinking and analysis to derive actionable insights. Analytical techniques. Chart analysis. Larry begins using charts to visualize stock price movements. By analyzing historical price patterns, he identifies trends and potential reversal points, helping him make better trading decisions. Technical indicators. He incorporates technical indicators into his observation strategy. Tools such as moving averages, RSI, relative strength index, and MACD, moving average convergence divergence, help him analyze price trends and momentum, allowing for more informed entry and exit points. Record keeping. Livingston starts keeping a trading journal, documenting his observations, trades, and outcomes. This practice allows him to review his performance critically, identify patterns in his behavior, and refine his strategies based on past experiences. Learning from mistakes. One of the most powerful lessons Larry learns through observation is the importance of learning from mistakes. Each time he faces a setback or an unexpected market movement, he makes a point to analyze what went wrong. This reflective practice is key to improving his trading strategy. Reflection strategies. Post-trade analysis. After completing a trade, Larry reflects on his observations leading up to that decision. Did he notice any signals or changes in sentiment? Did he misinterpret any information? This post-trade analysis is crucial for his growth as a trader. Identifying patterns. By reviewing his past trades, he begins to identify patterns in his decision-making. He learns to recognize when his emotions might have influenced his observations, helping him develop a more objective mindset. Adapting strategies. As he learns from both successes and failures, Larry adapts his trading strategies based on his observations. This continuous improvement mindset is vital for long-term success in the stock market. Cultivating a patient mindset. Another essential aspect of observation that Larry emphasizes is patience. He learns that successful trading requires more than just quick decisions. It demands the ability to wait for the right opportunities to present themselves. Patience in observation. Waiting for clarity. Instead of jumping into trades at the first sign of movement, Larry develops the discipline to wait for clearer signals. He understands that sometimes the best action is to do nothing until the market reveals its direction. Long-term perspective. By maintaining a long-term perspective, Larry learns to appreciate the value of observation over time. Markets can be unpredictable in the short term, but sustained observation helps him recognize emerging trends that may take time to develop. Emotional detachment. Patience also involves managing emotions. Larry works on detaching himself from the immediate highs and lows of trading. This emotional resilience allows him to maintain a steady focus on his observations without getting swept up in the frenzy. Networking and learning from others. Livingston realizes that observation is not limited to individual analysis. It can also be enriched through interactions with others. He begins to seek out conversations with fellow traders, learning from their experiences and insights. Networking benefits. Diverse perspectives. Engaging with other traders exposes Larry to different viewpoints and strategies. These discussions provide valuable context and help him refine his observational skills by considering alternative approaches. Learning from mistakes. By hearing stories of others' successes and failures, he gains insights into common pitfalls to avoid. This shared learning experience bolsters his understanding of market dynamics and enhances his trading acumen. Building relationships. Establishing relationships with other traders fosters a sense of community. These connections can lead to collaborative opportunities, sharing market observations, and keeping each other accountable in their trading journeys. Conclusion of Chapter 8. Harnessing the Power of Observation. Chapter 8 of Reminiscences of a Stock Operator emphasizes the transformative power of observation in trading. Larry Livingston's journey underscores that successful trading goes beyond numbers and charts. It requires a deep understanding of market sentiment, economic context, and the psychology of other traders. By cultivating strong observational skills, developing analytical techniques, and embracing a mindset of continuous improvement, Larry becomes a more effective trader. His ability to learn from mistakes and adapt to changing market conditions reinforces the idea that observation is a lifelong skill crucial for navigating the complexities of the stock market. Ultimately, this chapter teaches readers that the power of observation is not just a technique but a foundational aspect of successful trading. By honing this skill, traders can position themselves for long-term success and navigate the unpredictable nature of financial markets with greater confidence. Chapter 9. Learning from Losses. In Chapter 9 of Reminiscences of a Stock Operator, Larry Livingston confronts one of the most daunting realities of trading: losses. This chapter delves into the profound lessons he learns from his setbacks and emphasizes the importance of resilience, reflection, and growth in the world of stock trading. For Larry, understanding how to navigate losses becomes a cornerstone of his trading philosophy. The inevitable nature of losses. From the outset of his trading career, Larry realizes that losses are an unavoidable part of the game. No trader, regardless of their skill or experience, can escape the reality that sometimes trades will go against them. This understanding is critical. It prepares him mentally and emotionally for the challenges ahead. Key takeaways. Acceptance of losses. Larry learns to accept losses as a natural part of trading. By acknowledging that no one wins all the time, he shifts his focus from trying to avoid losses to learning how to manage and learn from them. Emotional impact. He recognizes that losses can evoke strong emotions, frustration, anger, and disappointment. Understanding this emotional aspect helps him develop strategies to manage his feelings, and make rational decisions in the face of setbacks. The importance of reflection. As losses accumulate, Larry understands that it is not the loss itself that defines a trader, but how they respond to it. Reflecting on each loss becomes a vital practice in his trading routine. This reflection allows him to dissect what went wrong, recognize patterns, and develop strategies for improvement. Reflection strategies. Post-mortem analysis. After each loss, Larry conducts a thorough analysis of the trade. He examines his decision-making process, the factors that influenced his actions, and whether he followed his established trading plan. This post-mortem approach is crucial for identifying errors and preventing them in the future. Learning from mistakes. Each loss presents an opportunity for learning. Larry takes notes on what he could have done differently and seeks to avoid making the same mistakes again. This focus on improvement rather than self-blame helps him maintain a positive outlook. Adjusting strategies. Through reflection, Larry realizes the need to adjust his trading strategies based on past experiences. By learning from his losses, he develops a more robust and adaptable trading approach that can withstand market fluctuations. Building resilience. Another essential lesson Larry learns from losses is the importance of resilience. Trading can be a roller coaster of emotions, and maintaining the ability to bounce back from setbacks is critical for long-term success. Resilience becomes a defining trait in Larry's trading philosophy. Resilience practices. Mental fortitude. Larry develops mental strength to cope with the psychological toll of trading. He practices mindfulness techniques and visualization, which help him remain calm and focused during turbulent market conditions. Maintaining perspective. He learns to view losses in a broader context. Instead of seeing them as personal failures, he considers them stepping stones toward becoming a better trader. This shift in perspective allows him to maintain motivation and determination. Avoiding revenge trading. One of the biggest traps for traders after a loss is the urge to get back at the market through impulsive, revenge-driven trades. Larry becomes acutely aware of this temptation and consciously avoids it by sticking to his strategy and maintaining discipline. Cultivating a growth mindset. Larry's journey through losses leads him to embrace a growth mindset, a belief that skills and intelligence can be developed through dedication and hard work. This mindset shift is transformative, allowing him to approach trading as a continuous learning process. Growth mindset principles. Embracing challenges. Larry learns to welcome challenges rather than shy away from them. Each loss becomes an opportunity to test his resolve and strengthen his skills. Seeking feedback. He actively seeks feedback from other traders and mentors, valuing their insights on his performance. This collaborative approach fosters a supportive learning environment that accelerates his growth. Setting realistic goals. Understanding that losses are part of the journey, Larry sets realistic goals for his trading performance. Instead of fixating on profits, he focuses on mastering his trading process and developing discipline. The role of risk management. In the context of learning from losses, risk management takes center stage. Larry realizes that while losses are inevitable, they can be mitigated through effective risk management strategies. Key risk management techniques. Setting stop-loss orders. Larry adopts the practice of setting stop-loss orders to limit potential losses on trades. This technique provides him with a safety net, reducing the emotional burden of watching a trade go against him. Position sizing. He learns the importance of position sizing, allocating only a small percentage of his total capital to any single trade. This approach minimizes the impact of any one loss on his overall portfolio, allowing him to trade with greater confidence. Diversification. Larry starts diversifying his investments across different sectors and asset classes. This strategy helps him spread risk and avoid catastrophic losses that could arise from being heavily invested in a single position. The long-term perspective. Throughout this chapter, Larry emphasizes the significance of maintaining a long-term perspective in trading. He understands that one bad trade or a series of losses should not derail his entire trading career. Instead, he views trading as a marathon rather than a sprint. Long-term mindset strategies. Focusing on the bigger picture, Larry learns to evaluate his performance over months and years rather than fixating on day-to-day fluctuations. This broader perspective allows him to remain calm and composed, even during challenging periods, celebrating small wins. In addition to reflecting on losses, Larry also takes time to celebrate small victories along the way. Acknowledging progress helps him stay motivated and reinforces the idea that improvement is a gradual process. Commitment to lifelong learning. Larry adopts a commitment to lifelong learning. He recognizes that the markets are ever-evolving, and staying informed and adaptable is crucial for long-term success. Conclusion of Chapter 9. Embracing losses as learning opportunities. In Chapter 9 of Reminiscences of a Stock Operator, Larry Livingston teaches readers that losses are not the end of the journey but rather integral to it. Through acceptance, reflection, resilience, and effective risk management, he transforms setbacks into opportunities for growth and improvement. By learning to embrace losses as part of the trading experience, Larry cultivates a mindset that empowers him to succeed. He demonstrates that the true measure of a trader lies not in their ability to avoid losses, but in their capacity to learn, adapt, and persevere in the face of adversity. This chapter serves as a powerful reminder for all traders. While the market may be unpredictable, our responses to challenges can define our paths to success. Learning from losses is a vital component of mastering the art of trading, and those who embrace this lesson are better equipped to navigate the complexities of the financial world. Chapter 10. The Art of Patience. The final lesson that struck Sam was the importance of patience. Larry's story illustrated that success in trading wasn't about constant action, but rather about strategic waiting. Sam had always felt the pressure to trade frequently, but Larry's patience showed him the value of waiting for the perfect opportunity. Sam learned that by exercising patience, he could avoid impulsive trades and focus on high-probability setups. This lesson helped him adopt a long-term perspective, allowing him to make fewer but more successful trades. Conclusion. As Sam applied these lessons from Reminiscences of a Stock Operator, he found himself transforming as a trader. The book became more than just a story. It was a roadmap that helped him build resilience, discipline, and patience. With each lesson, Sam grew more confident and capable, his success a reflection of the principles Larry Livingston had learned a century earlier. Today, Sam is a successful trader, but he knows that the market is a constant teacher. Larry's story taught him that trading is a journey, where the true measure of success lies not only in profits, but in one's ability to learn, adapt, and overcome. For Sam, as for Larry, the market became more than a career. It became a lifelong pursuit of growth, self-mastery, and wisdom.